it. Well, thanks for all of you for participating in this webinar. This is very much on the fly. Meaning, obviously the situation, as we've heard a lot this week, is fluid. A lot of the notes that I've taken over the last few days have already become outdated. And so if it's very possible as I'm talking that something will change even then. So you can certainly ask me questions on something that I probably haven't seen yet. So before we start, let me give you a little bit of background on me, both in terms of my experience and my research. So I'm a macroeconomist by training. I've been at Drew for about 13 years now, and before that at 2 other liberal arts colleges. The courses that I regularly teach include introductory and intermediate macroeconomics. I teach finance, corporate finance, and money and banking. And I also teach classes in behavioral finance. In terms of my research, I have 2 main research areas. One has to do with how a central bank's actions and words affect financial markets. I look at not only the US Federal Reserve, but also other central banks around the world. My second strand involves income convergence. So what factors affect whether poorer regions or countries catch up to richer ones. So all this is to say, I'm looking at this seismic event through the experiences and perspectives I've gained from over 2 decades of talking about and studying this field. So today's discussion centers around the health crisis that has rippled through the entire world over the past several weeks. Like all of you, 3 weeks ago, my life was pretty unaffected by the events in China, and I was about to actually take a group of Drew business students to Switzerland during our spring break. Right now, just a few weeks later, most of you are watching me from your home offices or kitchens or bedrooms. And I myself am my lovely home office here. So what I want to talk to you about today is the economic and financial ramifications of this situation we're all in. I mean, it's a crisis, as I already said. It escalates daily, if not hourly, in terms of its severity and in terms of both its short-term and long-term implications for all of us. I have no doubt that you all have a lot of questions. So do I. In planning this webinar, I've drawn a lot from online sources. But like I said, the news is continually changing. Despite the real life nature of what's happening here in the real time news, the essence of this talk is rooted in ideas that have held true in macroeconomics for over a century. So I'll compare when relevant to what is happening now to what has happened in past economic and financial crises. In particular, I'm going to draw a lot and do comparisons to the 2008 financial crises, because that's what we tend to remember the most. But I'm also happy to go back, talk about the Great Depression, talk about, for example, the stock market crash in 1987, and really trying to put all of this in context. So as Stuart said, please feel free to ask questions through the chat function at any time or email questions. I'm happy to engage and interact with all of you, because that makes this a lot more interesting for all of us. So like I said, I want to talk about the economics and the financial market implications of this. I'm going to start with economics here because it's driving the lion's share of what is happening in financial markets today. So again, I have a PowerPoint presentation that I'll kind of cycle back and forth between, mostly just to show you a couple of graphs. I don't want to get lost in this. So let me start with the following. So in macroeconomics, like basic macro 101, what we really try to describe is that there's 3 main issues in all of macroeconomics. Any situation you ever look at, any country, any time period, it always comes down to 3 things. First, are issues involving economic growth. This could be either long-term economic growth like development or short-term economic growth like business cycle fluctuations, so things like expansions and recessions. Second, issues involving unemployment. And third, issues involving inflation. The other parts of macro that you always hear about or that you think about and read in the news, interest rates, money, Bitcoin, even financial crises, are relevant to policymakers and really to the average person, only the average household, for example, only to the extent in which they may affect a country's economic growth rate unemployment rate, and inflation rate. So what I want to do is I want to come back to each of those three topics and go into more detail and really talk about exactly how this pandemic has the potential to impact each of these three areas. So let's start with economic growth. To figure out if any of these three issues constitute a problem for an economy at any given point in time, we need some sort of variables, that is metrics to measure, hey, is this a problem? So typically what you see for economic growth, policymakers typically use gross domestic product, or GDP, as a measure of a country's economic output. The idea from this, more is better. The more a country produces, the better off it is. So this ignores factors like population growth. It also totally wipes away or pushes aside the issue of income inequality, which is huge, especially in the US during the past economic recovery. But GDP still works pretty well for at least what we're talking about today initially. So here's what I'm going to show you. I'm going to share the screen here. So let's pop in, just point out a couple things about economic growth and GDP in general, which are worth talking about. I'm not going to throw this into full screen mode because I want to have access to everything else. So let's just do the following. First of all, let's talk about gross domestic product. I'm going to focus on the demand side, really, which is the idea of who demands goods and services in an economy. Because when I talk about GDP and I talk about production, we tend to think about two components, goods and services. So we either think about tangible products being produced, like cars, or we think about services, like it could be financial services, it could be haircuts, any of that. But the important part and where it's relevant to today's talk is thinking about what are the four main groups in an economy that actually buy these goods and services. And so this is where we come up with, if anyone has taken, watching this, has taken macroeconomics, this canonical relationship between GDP and these four components. So more specifically, we say GDP is equal to C plus I plus G plus NX, where C stands for consumption, I stands for business investment, G stands for government spending, and NX stands for net exports, or exports minus imports. Now, each of these then is linked to one of the four main potential groups of entities that demand goods and services. So consumption, we talk about household consumption. So people like you or me. I, investment, has to do with business investment. And here I'm not talking about stocks and bonds. We'll get to that later. I'm talking about physical business investment. So we're talking about capital spending by businesses. Businesses going out and buying a fleet of delivery vans or drones or software upgrades or whatnot. So something physical, tangible, could be capital investing. Government spending, I'm going to come back and talk all about government spending in a little bit. But basically, we're talking about any spending done by the public sector. And then finally, net exports, the rest of the world, is the relationship. In this context here, I'm going to focus my talk mostly on the United States, is really thinking about goods and services that the US sends out of the country, and then minus goods and services coming into the country. All right, so with that in mind, what I want to do really quickly is get to the following. Out of these four components, and we think about these four areas, households, what households demand, business demand, the government demands, and the rest of the world. This is the important part. Here's the components of GDP and how they contribute as a share of GDP. So net exports isn't on here because it's weird and it's slightly negative. So I basically have netted it out to zero and ignored it. Here's the important part. Consumption for the US in 2018 constitutes almost 70% of GDP in the US. Business investment and government spending are about equivalent. They're about 16% each. But consumption, look at that, it's almost 70% of GDP. So I'm saying this because if you think about what has been happening over the last, especially week and a half, what are most consumers, that is, what are most households doing? We're all staying at home. I can't stress enough about the spillover effects from our collective inaction. None of us are shopping much except for essentials and probably board online purchases. This has incredibly large impacts on retail, on big ticket purchases. Even if I wanted to go out and buy a car, I can't because, you know, the car dealers are literally closed for the most part. Maybe you make specific appointments, but you're certainly not going around and browsing. And really, given all this uncertainty, who wants to actually go out and buy a car or a new sofa? There's also, in addition to this general drop in household consumption overall, there's also huge effects on very specific industries, right? So, and I'll give some data about this in a few minutes, but I mean, look at the effects, and you see this every day whenever you look at a news article. Look at the effects on restaurants. Nobody's going to restaurants right now except for pickup. Hospitality. So look at what's happening to hotels right now in terms of vacancies. Transportation, really of all sorts. I'm not only talking about public transportation and airlines, but also something like what's the effect on ride sharing like Uber and Lyft. I will point out though, you know, and I'll show this when we get to financial markets, some industries are less impacted. So in the pharmaceutical industry, okay, pharmaceuticals isn't being nearly as negatively affected because it's an inelastic good. People still need medicine. We know in the healthcare space, clearly that is doing relatively well in terms of people spending. Food production is fine. And also data or information providers. So you look at something like Comcast or AT&T or Netflix, right? But you can imagine, and I'll get to this in a minute when I talk about the overall effects on GDP, consumption right now is having a huge hit. Related to that, business investment. Business investment, and I'm not going to mince words here, business investment for this quarter and next quarter is probably going to fall off a cliff. That is capital spending. Now, it's not as big a part of as consumption is. And I'm not being dramatic about that statement about falling off a cliff, but the fact is business investment falls sharply in every single recession that you look at. I mean, think about it. Think about it from the point of business decisions. If you're running a company, whether it's a small business or whether it's a Fortune 500 company, why are you going to go invest in new capital? Are you going to actually go out and expand into new states or open new stores? Are you going to actually go and modernize your warehouses? Are you going to start a new branding campaign? Are you going to engage in any mergers or acquisitions? No, you're probably just going to hold off just like the rest of us are and say, you know what, I'm going to wait until some of this uncertainty dies down. And that's going to cause investments to drop also. Look, there's some big exceptions in terms of business spending. You can imagine companies are spending a lot on software and hardware to facilitate remote work and access. They're also probably bumped up their spending in cybersecurity as well. But those aren't enough to make up for these other huge drops in capital spending. Third component, all right, I'm going to pop this out right now for a few minutes and get back to our regular screen so you can see me. Give me 1 second here. Stop the sharing. All right, so government spending I'll get to in just a little bit, as I said. It's going to have an effect, but it's not going to nearly be enough to counteract what's happening to consumption and investment. And finally, net exports. What's happening with the rest of the world? Well, net exports is exports minus imports. And both of those are going to experience, if history is any indication, pretty big drops. This happens in 2008. So if both exports go down and imports go down, the difference between them probably shouldn't change that much. But while the net effect on US GDP might be small, of this drop in both exports and imports, our country is still clearly worse off, certainly in terms of employment. And I'll come back to employment in just a second. Think of US companies that were exporting goods to China or the UK. Any of those US multinational corporations, they're cutting back on production and they're furloughing or laying off their workers. So let's talk a little bit about some rough calculations we can do here when we think about the effect on US GDP and economic growth. According to the Bureau for Economic Analysis, the BEA, the accommodations in food services industry, so you can think about this as relating to hotels and restaurants, contributes to about 3.1% of US GDP as of 2018. Arts, entertainment, and recreation, other things that have been massively affected by social distancing, comprise another 1.1% to output. So you're looking at direct effects to 4.2% of GDP, like massive drops. But that's really just the direct effects. You also need to think about spillover effects. Someone working at a hotel or a restaurant who loses their job, or at least doesn't have an income for the next month, is going to cut back on a ton of discretionary spending. So they're not buying as many retail goods, and they're cutting way back on services. I mean, you name it, lawn care, haircuts, whatever. So the multiplier effects are going to ripple through many industries that don't appear to be directly in the line of fire of this pandemic at first glance. So take financial institutions, for instance. At some point, households who experience a loss in income or outright job loss are going to stop paying bills. Could be student loans, could be car loans, could be mortgages if things get bad enough. So even though, in contrast to a dozen years ago, this was not the fault of banks, this pandemic, if it goes on long enough, is going to turn into a financial crisis. So let me say this again. In other words, unlike 2008, a financial meltdown may be the consequence of the economic crisis rather than the cause. So let's go back to actual numbers here. It's all a big unknown. So all this is highly, highly questionable in terms of the actual numbers. But when you're looking at what are the effects on US economic growth in the first 2 quarters, or the first half of 2020, again, it's too early to have any good forecasts, but here's some really rough back of the napkin calculations. So let's take the first quarter, the first 3 months of this year. The US has had 2, we'll call normal months of activity in January and February. I've seen some admittedly questionable estimates of a drop in output, an estimated drop in output, drop in GDP of anywhere from 1 to 3% from the previous quarter. The Atlanta Fed has this GDP Now forecast. It's still showing 1% growth for the first quarter, but this is based on all released US macro data. Since all data has a lag, we're still only have the data from February, so we don't have anything new from the last few weeks, with one exception that I'll get to. Second quarter, the second quarter of 2020 is the real question. That starts April 1st. So how badly output is affected completely depends on when new virus cases in the US begin to slow. One optimistic scenario that I've seen is that we begin the road back with store and restaurant openings at least some limited capacity by mid-May. In this case, you're probably looking at about a 5% drop in GDP from the previous quarter. But if this lasts through the end of June, with shelters in place, and I did just see about an hour ago what New York State stated about this, that all non-essential businesses are closed. So something like that continues in large parts of the country, then this drop in GDP for second quarter can be far, far worse than 5%. Let's look at a comparison really quickly. So to give you an idea of magnitude and comparisons to what we were seeing during the financial crisis, here's it. If you look at US economic growth from, let's say, 2006 to where we are today, what you're picking up is during the worst of the financial crisis, which is right over here, basically from mid-2008 to mid-2009, the worst quarter, which was fourth quarter of 2008, the US experienced a drop in economic output of about 8.1%. First quarter was quite a bit better. It was about 2.5%, and then by mid-year of 2009 came to 0. And so what we're saying is first quarter isn't going to be quite as bad as this drop, but second quarter has the potential to be actually potentially quite a bit worse than the financial crisis itself. Again, there's a lot of uncertainty here. Okay, so that's economic growth. That's the first main issue, and that's actually the one I wanted to talk most about. But let me talk about these 2 other issues which rear their head in macroeconomics. One is inflation. So what we're seeing here is a massive drop in demand for goods and services. And corresponding to that, you're going to see the inflation rate in the US which has struggled to hit 2% over the last decade since the financial crisis, that inflation rate is going to fall. How far it actually falls matters, because 0 is not the lower bound. In fact, price levels can actually start going down. If they do, we could run into a situation known as deflation. So deflation is a situation where average prices start to fall, and with it, wages start to fall as well. This historically is a horrible situation for borrowers. See, since costs are fixed, so you think things like loan payments, doesn't matter how much you're making, doesn't matter what happens to your wages, the fact is you still owe $700 a month on your car loan. So the problem with this, when you have price levels falling and hence wages falling, this can lead to a spike in defaults by borrowers, which harms credit channels. Banks are less willing to lend then because they're really worried about this increased defaults. So households and businesses become credit constrained. They simply can't borrow as much, nor do they really want to. So this causes consumption, investment to fall, leading to price levels falling further. And so this turns into this huge debt deflation cycle. The good news, in some ways, is this is pretty rare in terms of US history. The last time you actually saw a protracted period of deflation was during the Great Depression, especially between about 1931 to 1938. And sure enough, you saw massive numbers of bank failures, and you saw the US basically stuck in a recessionary period due to that drop in inflation. Okay, so that's number 2. Number 3 is unemployment. So exactly what happens to US labor markets right now depends, of course, on the length of the US outbreak that we're looking at. It's also highly industry dependent. Again, we're seeing all sorts of numbers, but the at-risk areas include the biggest industries that have to worry right now are, of course, transportation and travel, leisure and hospitality, but also temporary health services. And given the huge drop in oil prices, oil drilling and extraction are also, the jobs are at risk there. One of the huge issues associated with a spike in unemployment, especially now, is associated with the uncertainty that I already talked about, especially on the business investment side. If a person loses their job now, they're potentially going to be unemployed for a long time. And this question of long-term unemployed workers was especially worrisome in the aftermath of 2008. Now, the data coming in is really, really preliminary for what we're seeing. So really quickly showing you where we are in terms of some numbers. It's worth pointing out US weekly unemployment claims. So I'm mentioning this because US weekly unemployment claims jumped yesterday, or for the past week, to 281,000 workers who filed for initial claims. This is the highest level since 2012, right after Hurricane Sandy. But when you compare it to the high of 2008, the worst week of the financial crisis turns out to be March 28th of 2009. It's right around here, when 665,000 workers in a single week filed unemployment claims. So when you look at this spike that you're seeing in the historical graph, yeah, it's a worrisome spike, but again, still nothing compared to what we have in the financial crisis on labor market grounds. But we know things are going to get a lot worse. We just don't know how much worse. We don't know if it's going to end up in a period like this or something that's more moderate. And it's all going to depend on how quickly we can get a handle, how soon can we return to any sort of normalcy. All right, so popping back here. All right, so now that we understand what is at stake here, let's turn to policy actions, okay? There's 2 broad types of policy actions that can be brought to bear on the situation at hand. Number 1 is monetary policy, and number 2 is fiscal policy. So monetary policy, just to bring us up to speed, monetary policy is led by the Federal Reserve in the US and other central banks around the world. The actions of monetary policymakers are designed to largely impact consumption and investment. Traditional tools you see in monetary policy include interest rate changes, and we've seen a couple of those this past week, which I'll talk about. In the midst of the 2008 financial crisis. Under Ben Bernanke, though, several new tools were introduced in the Fed's arsenal, namely, number one, bond buying programs, and we'll talk about why in a minute. And number two, the creation of credit facilities to directly lend funds to institutions that needed it. Either while primarily, or initially it started as banks, these facilities actually ballooned to include a lot of other institutions, whether it's financial firms, even getting to the point of companies, across the spectrum of the economy. Fiscal policy. Fiscal policy is led by the legislative and executive branches of the US federal government. So we're really talking about Congress and the president, hopefully working together. In a nutshell, what fiscal policy is government spending and taxation. So with monetary policy and fiscal policy, let's talk about where we are today with each of these. Monetary policy. You can see this actually pretty quickly. I'm going to flip back to where we were in terms of, okay, one of the first things that happens is in terms of the federal funds target rate. What's interesting is you can see the United States, starting in December of 2015, started raising their short-term interest rates. The federal funds rate is the rate at which banks borrow from other banks. And the idea is by raising or lowering short-term rates, eventually long-term rates are going to follow. And that's historically been the case, barring a severe and sudden downturn. So the Fed actually got itself some breathing room, raising rates all the way up to the beginning of 2019, up to about 2.5%. But what you can see is, first at the very beginning of this month, the Fed had slowly lowered rates in little 25 or 0.25% increments until we got to early March. Early March, the Fed went from about 1.75 to 1.25%. And then on Sunday, the Fed made, and this first movement, I should say, was not during one of its typical policy meetings, but it acted before one of its meetings, or an intra-meeting decision. And then the Fed did so again this past Sunday, lowering rates by a full point and bringing it basically down to zero, or where it was during the worst of the 2008 financial crisis. So that was one of the first big actions that the Fed has taken to deal with this. Related to that, I mentioned about some of the more novel moves in monetary policy. And the Fed also announced on Sunday a massive bond buying program. It announced $700 billion in bonds that it was going to buy, split between about $500 billion in US Treasury bonds and $200 billion in mortgage bonds. And they also said that that's just the beginning or the minimum, and they're prepared to step in and buy more. So what's with the bond buying program? Well, a couple of things. One, we've hit a lower bound on what it can do to short-term rates through the federal funds rate. It's at zero, and the Fed's not willing to go below zero. Really strange things happen in an economy when you start having negative interest rates. And so basically zero is as low as the short-term rates can go. The problem, what the goal of the bond buying is the Fed is trying to raise the price of these bonds, which lowers the interest rates associated with them. Because once interest rates are highly correlated with one another, once you can start lowering long-term rates, and again, the government bonds that the Fed is buying are 30-year bonds. So what the Fed's trying to do is cause long-term borrowing costs to go down in the economy. Why is this useful? Because again, going back to the elements of economic growth, consumption and investment in particular, they're trying to lower borrowing costs for households and businesses. This hopefully will cause people to buy new houses, cause businesses to step back and actually start investing in new capital spending plans. Here's the thing though. So even though the Fed's doing this, even though the main goal is to lower borrowing costs to these groups, it's not clear that it does anything tangible in an actual panic. And we can talk about later, and I'm happy to answer questions as to whether this constitutes a panic right now or something else. But you can imagine in this time period, business investment is going to remain remarkably insensitive to changes in interest rates until at least some of this uncertainty dies down. So it's possible, perhaps some of the Fed's actions are designed really to alter the psychology of investors and borrowers, to basically say to them, we're here to help. It's not as bad as it looks right now. And hopefully once people calm down, then these lower interest rates will really help to jumpstart the economy. All right, so that was Sunday. Just kind of talking about where we are now. On Tuesday, the Fed launched one of these new extraordinary lending facilities, launching what's known as a commercial paper lending facility. And that's designed to keep liquidity flowing in money markets, to basically keep those credit channels open. Because the last thing we need is for this pandemic to suddenly go into a seizing of any sort of credit channels like we saw in the fall of 2008. The Fed's also announced that they're prepared to create more of these lending channels designed at very specific types of borrowers if needed. Again, this is what the Fed did starting in December of 2007 through the end of 2008. They created, if I recall, at least 7 different types of new lending facilities, each aimed at different parts of financial markets. One designed to lend to banks, one designed to lend to money market funds, one designed to lend to primary dealers. And so again, they're ready to do that if things continue to spiral. Yesterday, the Fed announced that it would provide liquidity to a number of other central banks around the world as needed. So basically acting as what we sometimes call in our classes a lender of last resort. So even if there's seizures in credit channels in, let's say, Australia, the Fed's willing to step in and help. I will, point out, there are some critiques of these actions, right? So one question is like, what ammo is left in the tank here? So one of the things I've heard is, did the Fed act too quickly and too soon? In contrast to most other central banks, the Fed actually had its target interest rate significantly higher than 0, as I just showed, coming into 2020. Because of this, the reason for this is the US has pulled out of the 2008 financial crisis far better than most other countries and regions, like the EU, which has still struggled. And the issue with the EU right now and the European Central Bank is coming into this pandemic, their interest rates were already at 0. And so it's very limited in terms of what it can do. The ECB did announce Wednesday night into Thursday morning a new bond buying program, which kind of settled things down a little bit. And the Bank of England, who had raised rates a tiny bit, announced a rate cut. But at the margin, we're talking about very small interest rate movements. So monetary policy is limited. And that takes us into the only thing that policymakers can do that can hopefully try to quell a lot of this uncertainty, which is fiscal policy. So on the fiscal policy side, and we've heard a bunch of things this week, so I'm going to talk about as much as I know about it. Initially, there was an $850 billion aid bill proposed by Congress. It is now ballooned into about $1 trillion. And in comparison, comparing back to the fall of 2008, we saw a bill that was passed in late September of 2008 that was about $790 billion. So this is a little bit bigger than that in terms of magnitude, but roughly similar. The bill that was, again, just passed by Republicans and Democrats, it has 4 pillars to it. The idea is, number 1, to give direct cash payments to individuals. Number 2, to provide payments and loans to small businesses. Number 3, give loans to industries decimated by this virus. So best example I can think of is airlines. And 4, a boost in government spending and funding for the healthcare industry. So the details for all 4 of these pillars are still being worked out. But I can tell you this. Let's talk about the payments the direct cash payments to individuals. The idea is these are going to be sent to people as soon as the week of April 6th. One of the problems traditionally with government spending is there's a lag associated with it. That is, Congress can vote, Congress and Senate and the President can all agree to have an aid package, but the question is how quickly does that money actually get out to the people that need it? One of the really smart things about this federal aid package, which is being discussed, is the fact that the money will reach everyone so quickly that it will have an immediate effect, as opposed to, hey, we're going to pass, you know, $100 billion infrastructure spending package to make our bridges better. It's going to take a long time to come up with plans and hire people and build a bridge and actually see positive effects. This should help to keep consumption from cratering further. One of the critiques of the direct cash payments to individuals has been, though, okay, this is awesome, this is great. Is this a one-time thing? Okay, it's nice to get $1,000 or $1,200, but a one-time payment isn't going to do much long-term. So is this going to continue? Are there going to be future payments? How's this going to work? You know, and this actually moves into, if we think back to the, a lot of the political debates going on the Democratic side, one of the suggestions that was actually pitched by Andrew Yang was universal income, which is the idea of, hey, could you have continual payments going out to households? It'll be really interesting to see when this is all said and done, whether the discourse comes back to something like that. Really quickly, the cash handouts, the way it's scheduled right now, it's up to $1,200 for each US taxpayers, so adults, and $500 for children, depending on income level. So there's full payments up to $75,000 and then a sliding scale to $99,000. And if you individually make more than $99,000, then you're not going to get this money. There's lots of details I'm skipping in the interest of time. There's criticisms, of course, about it. It's very, very hard in real time to come up with a plan that is going to be fair, that is going to be quick, that won't have some mistakes or questions along the way. Okay, so the issues with fiscal policy. Of course, our federal deficit is going to absolutely dramatically increase. And it's going to happen for two reasons. One, we're spending more. And two, at the same time, as people lose their jobs, tax revenues are going to fall. Okay, so you can imagine negative effects on sales taxes because we're not buying stuff, so states are now not flush with cash, even if they were before. Income taxes, so that tax revenue is going to fall, and also things like property taxes. If this goes on long enough and really affects households, resale values, and then assessments. Historically speaking, if you look at the current size of the deficit in the US federal deficit is about 10% of GDP. So it's high, but if you go back and compare to the Great Depression, during the worst of the Great Depression, government spending was about the government deficit was about 20% of GDP. So if there's an appetite for both in the US and globally for US Treasury bonds, which would really finance this deficit, then it's possible for it to go quite a bit higher and for additional fiscal policy measures to be used. Okay, so that's the economic side. I'm going to be shorter on the financial market side because I feel like there's going to be some questions. But let's talk a little bit about financial markets. So I want to talk about stock markets. I want to talk about individual equities. I'll quickly mention bonds and housing and commodities, and then a comparison to the 2008 financial crisis. So that's a lot that I just said. And so in this case, I'm actually going to fly through a lot of information. So let's talk about stock markets. Let's look at the Dow Jones Industrial Average for no particular reason other than it's an interesting one to see. Forgive my less than stellar graph. I literally just put this together an hour ago. But historically speaking, in terms of the Dow Jones Industrial Average, where we are now, right before the financial crisis in 2008, the Dow Jones Industrial Average was at a level of about 13,000. It then dropped during the fall of 2008, recovered a little bit, and hit a low of approximately a little under 7,000 back in early March of 2009. Starting with the Fed's big action in mid-March of 2009 with quantitative easing, the US economy, pulled out of the recession, and you can see stock markets did an almost a staggering increase over time. A couple of little hiccups along the way, but nothing huge. And you can see that even as recently as January of this year, the stock market, again, the Dow Jones went from 7,000 all the way up to almost 30,000. And then, of course, we've had the events of especially the last 2 weeks. And so where this stands as of the end of close yesterday, the Dow Jones Industrial Average was just below 20,000. So historically speaking, we're still doing well compared to the end of the financial crisis, but looking more recently, this is what we have since the year started. And so it's worth pointing this out because you can see that even though in Asia, the coronavirus at the time outbreak was limited to just Asia, it really didn't have huge effects on US financial markets. And really that's even the case as far, going into that first week of March. And then of course, we've had approximately close to a 30% drop just in the last 3 weeks. And this is replicated, of course, in all your major indices, whether it's the NASDAQ or S&P 500. So that's the overall stock market. Individual companies. So I'll give you some interesting news. Of course, there's some carnage going on. Let's look at one of them. This is Carnival Cruise Lines since December. So Carnival Cruise Lines was, it's fascinating. It actually got higher than $50 a share. Even as late as mid-February, it was still trading at $40 a share. And what you can see is Carnival Cruise Lines is currently at about $9.30 a share. So it's lost about 80% of its value, most of which has happened in about a month's time. This is true for Royal Caribbean and Norwegian cruise as well. So that whole industry is, of course, decimated. In contrast, though, there are some areas which are relatively insulated. So let's take Walmart, for example. So it's interesting, and again, you think about this from a fundamental standpoint, Walmart, of course, has had massive price fluctuations, but the fact is Walmart's price at this point, looking at this data, is a little over $120 a share. You go back to December and it was trading about $115 a share. People need essential goods. They still need to go grocery shopping and they still need stuff. And so Walmart is this incredible bulwark against this pandemic. Another company that's actually in the same position for different reasons is one which is kind of the focus of this webinar, which is Zoom. If you look at Zoom's share price, not only is everyone using Zoom now, but a lot of people are thinking, wow, this could actually convert the way that I actually do business. I don't need to travel nearly as much. So I'm going to keep using Zoom and pay for it. All this is basically showing that not all companies are being crushed by what is going on here. So let me just pop out of this. All right, those are my visuals for today, in case you're wondering. You'll just have to watch me the rest of the time. So in terms of bonds, so what we've seen with bonds, especially, I mentioned the 30-year Treasury bond. It's near historical lows. Again, there's a flight to safety that happens in a situation like this with great uncertainty. So a number of individual and institutional investors have gone off and gone to something that has almost no default risk. Is exactly what we saw in 2008 also. So in this case, the 30-year Treasury bond interest rate dipped below 1% about 10 days ago. It's actually come back a little bit. It's about 1.5%. But I mean, think about this. You go out and you buy a 30-year bond, and it returns 1.5% on average a year for the next 30 years. That's remarkably low. And so, and this isn't even taking into account inflation. Inflation in the US has hovered around 2% over the last 10 years, maybe a trifle below. So investors basically are buying this, knowing that in real terms, if they are lucky, they will break even. And that's okay to them, given all the volatility that they're seeing in the markets. On the housing side, no idea what's happening in terms of housing prices yet. We will have to see how badly this affects home prices. But on the mortgage rate side, what's really interesting is that mortgage rates have actually risen over the past week. About a week ago, the 30-year fixed rate mortgage was about 3.3%. Now it's actually up, despite everything that the Fed's done, to about 3.6%. Thanks in part due to two things. Number one, a lot of people are refinancing because the rates are so low. This is putting upward pressure on prices. So the prices are going up. Secondly, the government stimulus package, it's pretty clear that increased government spending is going to lead eventually to higher interest rates. And so that's what you're seeing here. On the commodity side, one of the big reasons for the market downfall on Monday. So it's easy to forget this. Last Thursday, we had a huge plunge in the markets of about 7%. Last Friday, about 7 days ago, markets came back at the end of trading due to a government press conference that happened about 3 o'clock. So markets came back almost all the way. And then more things happened over the weekend, and the markets on Monday dropped a whole 10% in one day. The worst one-day drop since the 1987 stock market crash. One of the big reasons for that on Monday was a plunge in the price of oil. So oil right now is currently trading at about $23 a barrel. It's the lowest prices seen since early 1999. And certainly a lot lower than they were even during the worst of the financial crisis in the fall of 2008. However, one of the big differences is, unlike then, most of the time, once oil gets below a certain price, it actually lifts the economy somewhat. Because again, lower input costs, it helps businesses, it helps in terms of our costs of, for example, commuting or traveling. Consumers this time aren't benefiting, at least not right now, because we're all staying at home. So we're saying, great, oil prices are cheaper, we can't go anywhere. But obviously it is having a big negative effect on the oil industry. It also is going to have an effect negatively on the move to solar power. And of course, it's affecting companies like Tesla. So let's compare some of this to the 2008 financial crisis, okay? So unlike then, the coronavirus and the associated pandemic is an example of a purely exogenous shock. So what I mean is this is something that is totally unexpected. It's not due to the actions of policymakers or citizens. So in this case, it's really more like a meteor striking the earth than the result of, say, banks lending too aggressively to households with less than stellar credit. So probably a comparable recent analog to what we're seeing now, though again, it's not perfect, is the 2011 earthquake and tsunami that struck Japan, and seeing what the effect is on their economy. Nobody could predict it. It came out of nowhere, and we've all been forced to be on our heels and react to it. So again, another difference I should point out, this is different. What's happening now is different from the financial crisis also because it's not financial in nature, at least not directly. Financial institutions now are far more stable. There's been far more regulations, far more capital controls by any risk metrics you can think of as compared to early 2008. So I'm going to end with this. The question that all of you are wondering is, and what I'm wondering is, when is all of this going to get better? When do these big balls of uncertainty start to shrink where we can get a better handle on the problem that's confronting us? If I knew completely and I had a crystal ball, I would work on helping society. Goldman Sachs economist a few days ago estimated as an optimistic scenario the following. He actually thought that there would be a 5% drop in US GDP in Q2. Okay, so 5%, quite a bit less than what we saw during the financial crisis in Q4, followed by a V-shaped recovery as the coronavirus effects fade in early summer. So what he's actually calling for is 2% growth in Q3 and 3% growth in Q4. Now, this forecast was done back in a couple days ago, probably around Monday. We are 4 days later. I've not seen anything new since then. And obviously it's an optimistic scenario. It actually follows quite well what happened to the financial crisis. A lot of people have different opinions about this. So that's what I'll leave you with. And I'm happy to open up to questions right now.
Thank you, Professor. This is Stuart Desenhall again from Drew Communications. We had a couple questions come in, a couple that you ended up answering, a couple that I don't believe got answered. I'll rattle off 3 of them one by one, and then unless there's any more, we can close shop. So the first is that Wall Street has stopped trading a few times. Is there a reason why they've not just stopped for a longer stretch as people continue to panic? And yeah.
Okay, it's a great question. So circuit breakers have been in place on US financial markets since the stock market crash in 1987, because there's this idea that there's this momentum surge. That is, once stock prices start going down, a lot of people read that news and they also will start selling. And this can lead to a runaway train effect. And so as a result, designed to calm people down is putting in these time-based circuit breakers. And so where the circuit breakers are right now, these have changed over the last, they've been altered after every new crisis, I feel. But how the circuit breakers work right now is if markets, the major indexes, fall by 7% from the beginning of trading to that point, markets will stop trading for 15 minutes, and then you will continue. If markets then, once trading resumes after 15 minutes, and again, the idea is to calm people down and just say, look, are you doing these trades because of any fundamental reasons, or are you just scared? Trading resumes after 15 minutes. The second circuit breaker hits at 13%. So if markets go down by 13%, then from the beginning of trade, so they continue going down, another 15-minute halt is done. Trading resumes if you're not at the very end of the day. If markets, the third circuit breaker is at 20%. If the market drops by 20% in a single trading session, then trading stops, halts for the rest of the day. So what we've seen here is, yeah, we've seen 4 cases in which the 7% circuit breaker has been triggered. Trading is resumed, and in almost all cases after trading resumed, the markets either stayed the same or actually started going up. Now, it's not to say that later on in the trading session it dropped a little bit, but in no cases did we hit the 13%. I guarantee that regulators are looking at the circuit breakers right now and wondering if this is the best system that is in place, or should either the thresholds be different or should the time delay be different as a result of this. But yeah, that's basically the idea of the circuit breakers.
Great. Okay, the second of the 3 that we still have, will bailouts for industries under pressure, like you mentioned, Carnival Cruise Lines and airlines, will that help their stocks, or is that more about them staying afloat themselves and keeping their employees employed?
I think they're related. I mean, look, here's the big question. Your Carnival Cruise Lines, are you going to stay in business? Are you literally going to still be in business in 2 years? And if a bailout will get you to the point where, again, you're taking a loan from the US federal government and you are still, I don't want to say above water because it's a cruise line, but if you're still in business, then your stock price is going to be a lot better than if you go bankrupt. So the bailouts should help the stock price, but it's no guarantee. What we saw after 9/11 is we saw a number of the airlines end up declaring bankruptcy. Not because they were going out of business, because they absolutely fundamentally needed to restructure. So it was a Chapter 11 bailout instead of a chapter, which is a reorg, rather than a Chapter 7, which is liquidation. So American Airlines, for example, declared bankruptcy, pulled out of it several years later. And in that case, the existing stockholders under that bankruptcy were pretty much wiped out. I can imagine that, especially since, like 9/11, this has nothing to do with business decisions of airlines up to this point. That's completely, and like I said before, an external exogenous shock that the US federal government is doing everything in its power to make sure that those bankruptcies don't happen if they can at all control it. So it should help shareholders.
Great. Let's see, we just got another one in. Will this affect the amount of money Fafsa will give out in student aid support for the upcoming school year?
That is an excellent question. And right now, I would guess we are in a period of triage, which means that all the government agencies are right now trying to figure out what to do now. And so the big question is what to do about student aid right now, what to do about loan payments. Do you defer current loan payments for students who graduated last year, especially since they are in danger of losing their jobs if they're in high-risk areas. I think that has been the big focus right now, is trying to not make things worse for current people. But on the Fafsa side, I don't know to what extent that conversation has taken place. It's going to have to be done, and the higher education space, just like so many industries, is going to be massively disrupted by what's going on, especially if this continues. We've seen it at Drew, right? We've gone from a situation in which 2 weeks ago, was it even 2 weeks ago, that it was announced we were going online for 3 weeks. Then just a few, on Tuesday, we announced we're going online for the rest of the semester, and we're going to be online in the summer. I don't know what happens if this continues and goes into the fall. But all I know is all of the assumptions that I made 3 weeks ago, you can't make those assumptions anymore. You can't be like, oh, that's never going to happen. Clearly, anything is on the table right now. I would imagine even if FAFSA changes, it's how it's making decisions about student aid, institutions at the same time are going to probably have to get more lenient and give more aid to students, given this new era of uncertainty. And it's certainly the effect on any portfolios of any savings that have been done for the express purpose of attending college.
Thank you. And then last one, unless we get anything while you're answering this one. Can we expect the stock market to climb to its all-time high anytime soon, or is a slow trickle upwards the best that we can hope for right now as we recover?
Can you say the first part again?
Sure. Can we expect the stock market to climb back to its all-time high anytime soon, or is it a slow trickle upwards? Is that the best we can hope for? Based on reasonable expectations, I think.
I like the optimism there. All right. Like, when are we getting back? Historically, if you look at the effects, the financial market effects of pandemics across other countries in different time periods, economies tend to bounce, or financial markets tend to bounce back fairly quickly once the epidemic or pandemic is under control. That is, things tend to return to normal fairly quickly in financial markets. This is, of course, seems different to me than other situations we've had with SARS or MERS, because it is so global in scale, and because the massive restrictions in place for our societal interactions. I do think things will come back, but I think that until we completely remove the uncertainty, I don't see the valuations we've had before, certainly at the beginning of the year, returning anytime soon. Certainly not by the end of the year.
Great. I think
about it right now. It's March. Think about everything that's happened in the last 3 months, right? We got another 9 months left of this year. No idea what's going to happen.
Great. Thank you so much, Professor Tomljanovich, and thank you so much for everybody who has, actually, we just got another one from one of our students, Joseph Abagno. If you don't mind, one more question.
Sure.
Let's see. You've mentioned financial institutions being more heavily regulated. Do you see repeat of mass defaults on loan obligations, in turn affecting trillions of derivatives attached to these loans? What kinds of policies would go towards solving this potential problem?
So I think the question really is involving, and again, this is a little more granular, it's involving counterparty risk. It's number one. And number two, how heavily levered are a lot of these borrowers? So that is, are they actually able to repay these loans? And what happens if they don't? What kind of spillover effects are there? To this point, we have not seen massive disruptions in the financial markets. I know we like the stock prices, absolutely. But what I'm talking about here is the parts that the Fed is actually trying to really regulate and make sure that those markets do not seize up. And those involve, for example, the collateralized mortgage obligation markets, the ABS market that Joseph's talking about. In the worst of the financial crisis, in 2008. And again, that was much more of a financial crisis than this is at this stage. Those all largely worked. The big exception was AIG, and the government had to step in and bail out, essentially. So AIG, in case you don't know, is the world's largest insurance company, and the US federal government eventually bailed them out to the tune of about $100 billion. But the markets themselves didn't then have the problems of counterparty risk and then having massive ripples throughout the rest of the economy that, that lasted for decades. That did not happen. So I don't see those problems happening here. At least for right now, the regulations that were put in place post 2008 seem to be holding pretty well. But we got to wait till this ends or gets better before we really think about, okay, what new regulations are in place to prevent the problems that we're seeing right now happen again. And that's really the cycle of regulation and booms and bubbles and whatnot. Is first, for whatever reason, you have deregulation. There's a new market or a new area that manifests. Prices go up, sometimes to irrational levels. You get a crash, and then you get regulation, and the whole thing starts again. Again, in this case, it's not a financial crisis that's starting all of this. It's something it's a very, very different animal.
And to that point, we actually had one last question, then I'll officially close it off. Markets are down 30%. How much of it is panic selling?
So I said before, I used the word panic and I backed off. I don't think it's panic as much as risk aversion stemming from complete uncertainty as to how long this is going to last. So I'll go with, like, I mentioned an optimistic scenario. So an optimistic scenario, it's great. Like, again, second quarter is bad. By the end of summer, everything's or by summer at some point, things start reverting back to some semblance of normalcy. And then we kind of go back to the way things were before over the fall and winter. That's awesome. We all hope that's the case. However, there was just an article in the Atlantic talking about how maybe it's not like that. And maybe maybe things temporarily get better, and then COVID-19 comes back worse than ever next fall and winter. And then you have a lot of institutions which weathered this one big hit. They're like, okay, that's over. And then a second hit comes. And that's when you're going to see just, across industries, just massive amounts of failures. And you can imagine it's going to happen in almost every industry in that case. That's a worst case scenario. And that's obviously, so the question of, like, how bad can it get? It all depends on how quickly we can get a handle on developing better safeguards and eventually a vaccine for this.
Great. Thank you so much, Professor, and everyone who tuned in. Like I said, this will go up on our YouTube channel and be shared on our social media channels. Thank you for everybody's time. Thanks, Professor.
Hey, thanks a lot, everybody, for staying on. Take care, guys.